Hello and welcome back to Chapter 4 Lecture Notes. And so in this one we're going to be talking about dealing with break even when we have multiple products. And then we're also going to be doing some additional problems, okay? So we have two situations with multiple products. If we have very similar products, different types of ice creams, different types of pens, different types of boats, then what we can do is we can calculate a weighted average contribution margin per unit. And then we can use that to do our break-even analysis. If we're Walmart and we sell a ton of different products, then what we're going to do is we're not going to even bother with trying to figure out, in terms of the exact products that we sell, how many napkins, how many paper towels, how many toothbrushes do we have to sell in order to break even. We're just going to calculate break even in terms of sales dollars because it just becomes too complex to do it for each unit and to calculate the sales mix. Okay. Now look at this. Look at this example. Suppose Master Pen Company makes two types of pens. Model A sells for $30 and asks for $15 of variable cost. Model B sells for $20 of variable cost. And here's what we call the sales mix. Master Pen typically sells two Model A's for every Model B. Calculate the weighted average CM per unit and then the break even. Okay? So I'm going to come over here. I'm going to say my CM for Model A is going to be equal to $15, right? The 30 minus 15. My CM for Model B is going to be equal to $30. Okay? So then what I do is I calculate my weighted average CM per unit. Okay? So what I say is, it says I have to use my sales mix to do that. Typically sells two Model A's for every Model B. So 2 times the 15 plus 1, 2 Model A's for every Model B divided by 3. So I'm just calculating my weighted average, and that gives me $20 per unit. Okay? Now, let's assume, so this is my weighted average contribution margin per unit. And so I'm going to take this problem further and assume that we have fixed costs of $100,000. Okay? And then we can calculate VE break even by taking our 100,000 divided by our 20, which equals 5,000 total pens, right? But that doesn't tell us how many pens are Model A and Model B. Well, we can use our sales mix to do that. We can see 2 out of every 3 are Model A. So 2/3 times the 5,000 is how many you have to sell for Model A. And then 1/3 times the 5,000 is how many we have to sell for Model B. Okay? So that's break even with multiple products. Okay? And we could use this technique when we have very similar products. Okay? And basically, we can estimate the sales mix. But there are going to be some times where we're not going to be able to estimate the sales mix. When we have when we have a lot of different products, we're not going to be able to estimate the sales mix. Okay? This becomes too complex. So, when we look over here, in this situation, that's what I was saying, when we have a Walmart or something like that, it doesn't make sense to ask how many units we have to be sold because the selling prices and the cost of each product can be so different, and it'd be very difficult to estimate the sales mix. So in that case, what we're going to do is we're just going to calculate the break-even point in terms of sales dollars. Okay? And so remember the way we calculate break-even in terms of sales dollars. Come over here and we say our fixed costs divided by our CM ratio. Okay? That's our formula. So in this case, we just look over here, we look at our total fixed costs. And then we can calculate our CM ratio. Well, I have to do it in terms of total. So I'm going to look at my 265. The CM ratio is my CM divided by my contribution margin divided by my sales. So which gives me, and I'm going to round up here, 0.482. So that I can take my 170,000 divided by my 0.482, and what that gives me right over here is my $352,830.19. That is my break-even point in terms of sales. Okay? Now, if we look over here, I have one more problem here for you. Suppose the company thinks it can increase sales by 10%. What is going to be the effect on company profitability? And what I'm going to say over here is I'm going to say see spreadsheet on Canvas, okay? That addresses this problem. So I have a spreadsheet on Canvas that I'm going to post, and it details several different ways to solve this problem. The easiest way is to just use the profit equation to solve the problem. But you can also use operating leverage, and you can also use the CM ratio to solve this problem. So there's multiple ways to solve this problem, okay? And I'm going to say see the spreadsheet posted on Canvas to solve this. When we talk about some assumptions about CDP, the main one is that we have a couple different ones that we can divide costs into variable and fixed, and that our variable costs per unit are constant, our fixed costs are in total are constant. So basically, we're assuming within the relevant range, and then finally that the sales mix is also constant. Okay. Service companies and not-for-profits can also use CDP analysis. Okay. So an example would be a social welfare agency of the government has a $900,000 budget appropriation, and those would be its revenues. Okay. And that helps once its variable costs have been, nope, I had the wrong page. It helps people seek employment. On average, the agency supplements each person's income by $5,000 each year. So this is their total revenues, right? That's their total revenues. And so this would be their variable costs, and then it says the agency's fixed costs are $270. How many people can they help? So we could come over here, remember revenues minus our variable costs minus our fixed costs is going to be equal to 0. So basically they're saying, how far does this $900,000 go? Okay, and so I can take my $900,000 minus my $5,000, which is how much I'm going to help each person with, times the number of people, minus my fixed costs, and then I can help 126 people. And let's say that the manager says, uh-oh, I think we're going to get this cut by 15%. Okay, so then what's my new budget appropriation? $765. So then I can just change this a little bit. It says I can only help 99 people, right? And so we say right over here, note that the percentage drop. So from 126 to 99, it drops by 21.4%. Okay, and that's more than the appropriation. That's a typo. It's more than the reduction in appropriation. The reduction in appropriation is only 15%, and that's because these stay the same. Okay? So what could the manager do to respond to this reduction in the budget appropriation? Could reduce the number assisted, down to 99. They could also focus on reducing that $5,000 per person, or they could focus on reducing their fixed costs as well. Okay? So I do have some additional problems here on pages 34 and 35 and 36, and so what I suggest is for you to pause the lecture video and then just pause it and then restart it while I go over each one of these. Okay? So I'm going to go ahead and go over these now. So it says our first one, our electronics company is developing a new product, surge protectors. Here's our unit costs, and these of course are all variable costs. And it says the company will also be absorbing $120,000 in additional fixed costs. The selling price, the break even, to calculate break even. How many surge protectors must they sell at a price of 14 to get additional $30,000 net operating income before taxes? And then this one is the after tax. Okay? So if we look at the problem, here's the solution. So we come over here, we take our fixed costs divided by our contribution margin per unit. The selling price is 14. You add up all these, and you get 8. The break even is 20,000 units. How many surge protectors do they have to sell to generate $30,000? If I take my 120,000 plus my 30,000 divided by my 6, which is my CM per unit, 25,000 units. Now to figure out the net income issue, I have to take my net income, right, want to get after-tax income, which would be my net income, divided by 1 minus the tax rate. So this is my $50,000 is my net operating income, and then I just go through and solve it like a regular target profit problem. I take my fixed costs plus my target net operating income divided by my CM per unit, and I have to sell 28,300 units. Okay. If we look at the next problem, Barnes Corporation right over here makes skateboards and is in the process of preparing the next year's budget. The pro forma income statement is as follows. Here's our sales, our cost of sales, we have our gross profit, and then we have our variable and fixed expenses right over here. Calculate break-even point for Barnes Corporation for the first year, and then we say the second thing for the coming year. Management of Barnes anticipates a 10% increase in sales, a 12% increase in variable costs, and a 45% increase in fixed costs. Okay, the break-even, to recalculate the break-even point. So we say over here, calculate the break-even point. So the first thing we actually have to do is calculate our contribution margin. And I take my 1.5 million minus my direct materials, minus all my variable costs, which is my direct materials, my direct labor, and my variable overhead, and also my variable selling expenses. And that gives me 825. This is my contribution margin. And then what I can do, and this is in terms of sales dollars, that's what that's asking, okay, because we don't know anything about units. Okay, so we take our 825 divided by our 1.5 million. This gives us our CM ratio. And remember, what I can do is I can take my fixed expenses, which would be my 100,000, and my 250, which is my 350, divided by my CM ratio, to give me my break-even point. Okay, that's my break-even point right there. Now it says right over here for the coming year we have a 10% increase in sales. So I took my 1.5 million times 1.1 gives me new sales. That also means that my variable expenses also increase by 10%. So my contribution margin also increases by 10%. So my new contribution margin is 894. And I divide that by my 1.6650, and I get my 0.5418 contribution margin ratio. I take my 350, and then I have my plus my increase in my fixed expenses divided by my CM ratio gives me 729,027. That's my break-even point in terms of sales dollars. My break-even point in terms of sales dollars up here was the 636. Okay. And then the last problem is our multi-frame product company, and this is a multi-product problem. Okay. So we say over here has the following revenue and cost budgets for 2 products, plastic frames and glass frames, and it says the unit sales equal to current demand, and assume that the company plans to maintain the same proportional mix. So then we can come over here, numerical calculations, calculate the number of units that multi-frame has to produce and sell in order to break even. Okay, so we can come over here and we can say our contribution margin, right, for plastic is going to be 5, and the way I get that is I take my sales price minus my direct materials minus my direct labor. And my contribution margin for glass is going to be equal to my 15 minus my 3 and minus my 8, which gives me 7. Okay, and so then it says my budgeted unit sales. So this is a 1 to 3 sales mix. So what I did is I multiplied it times the number of sales. This is basically the sales mix. And then I divided by 4. So could you just take the 1 times the 5 plus the 7 times the 3 and divide by 4 and get the same answer? Yes, you could. Okay, but I just weighted it by the total, and I divided by the total sales of 400,000 right there. That gives me 6.5 is the weighted average CM per unit. Then I take my total fixed cost of 975 divided by my weighted average CM per unit. I need to sell 150,000 total units. And then if you wanted to break this out, you could say I have 4, 1/4 goes to plastic, and then 3/4 would go to glass. Okay? That concludes the Chapter 4 lecture videos. Thank you so much.